In this video, we show you how a portfolio of going private transactions completed using evergreen equity splits can be constructed that will program fiduciary returns to match fiduciary obligations for stewardship investors. To show you that this works with real companies at scale and across the entire network of the economy, we have picked three large market-leading companies in three different economic ecosystems. One is in branded consumer products, another in industrial services, and a third is in information technology. Procter & Gamble is our consumer brands example. Schlumberger, an oilfield services and pipeline company, is our industrial sector example. And Microsoft is our technology example. Each of these companies is currently trading in the public markets. And what we are showing you here is how equity splits can be used to take these companies out of that buy-sell paradigm of speculative valuations and bring them into a new cash flow sharing paradigm for more effectively and efficiently delivering programmed returns to fiduciary portfolios. For each sponsored enterprise, we show you the amount of funds being invested, and immediately below that are the splits in cash flows that are going to flow into the portfolio. You will note that these numbers represent billions of dollars. This example is very large. The total portfolio is $353.42 billion. Portfolio cash flows start at $42.28 billion and grow to over $67 billion. You will see here we have presented the model splits for the first 5 years and then selectively at years 10, 15, and 20. This is in the interest of space and keeping the presentation compact. We do stop at year 20 because that is the limit of the base case. Within this period of time, we are expecting to exceed our fiduciary returns, fully recovering the corpus of invested funds and continuing to fund associated fiduciary obligations. As these arrows indicate, each of these sponsored enterprises is expected to keep operating beyond 20 years, and the equity splits will continue to pour cash into this portfolio. This is why we sometimes call them evergreen equity splits. They are a gift that keeps on giving. You can see down here that by year 20, all of the invested corpus has been recovered, while the equity splits continue to pour cash into the portfolio. By this point, all that cash is available to fund fiduciary obligations, which is much more than is actually needed, and so a surplus is being created. And this is actually a design principle for the evergreen equity split, to generate more cash inside a portfolio than is actually needed to sustain corpus plus benefits, and then to keep that cash flow pouring into that portfolio for as long as the sponsored enterprises remain competitive in their commercial markets. Returning to the summary, you can see here our equity splits are growing over time. This reflects an organic growth assumption that is included for each company in its base case. And this is in part how the IRRs grow to 6% by year 10 and keep growing to reach 13% by year 20. Note these IRRs are based only on the equity splits that are being paid out by the sponsored enterprises. The total cash flows within those enterprises will be higher. How much higher depends on how well the actual results match the base case. In a properly constructed base case, these actual results should always exceed modeled expectations by a comfortable margin. That excess goes to the leaders of the enterprise as their reward for doing what it takes to get corpus plus benefits paid out to their stewardship sponsors according to the program. The next line here shows the total amount of fiduciary funds invested in this portfolio. You can see we have kept this amount constant in each year. To keep things simple, we've not compounded for inflation. This is not an oversight, it is a deliberate choice. For this exercise, we wanted to avoid the complications that can arise when reinvestment is modeled to support an inflation assumption. We also do not reduce this number for investment recovery. In our program, fiduciary obligations are calculated as a percentage of corpus originally committed to a portfolio, not funds still at risk within the sponsored enterprises. So here we have identified three line items that make up our budgeted fiduciary obligations. As we just discussed, the first one, which is for inflation, we have intentionally omitted. This leaves us a payout of fiduciary benefits, which we have budgeted at 5% of the corpus, and an allowance for the cost of fiduciary administration, which we have budgeted at 1%. This gives us the sum of $21.21 billion that this portfolio must generate each year just to sustain its ability to pay benefits. In reality, of course, this number would be increasing year over year for cost of living and other such factors, but we have kept it flat to keep things simple. So here we bring down the total cash splits pouring into this portfolio each year and apply a portion to a planned program for recovering invested corpus, with the remainder being available to pay fiduciary obligations. This is what we mean by matching fiduciary returns to fiduciary obligations. And let's compare this to our historical experiences, which for stewardship investors really only began in the early 1970s with public markets portfolios. Their longevity is matched to the liquidity of transient ownership. Valuations are fleeting, and paper profits in one accounting period can evaporate in another, driving a recurring pattern of booms that always eventually go bust. This happened most recently and very dramatically in 2008, but it is a constant reality when mismatching longevity against liquidity. Net asset value is not a return. This line shows a surplus each year of cash available over cash required. This is what we really want to get, to generate a surplus like this. Some of this surplus would of course be absorbed by inflation. In the early years, real surpluses may be small to not at all. But over time, as the program for corpus recovery runs to completion, while the equity splits keep on pouring cash into the portfolio, these surpluses do become quite large, very real, and more or less enduring. This is matching longevity to longevity. The impact of the equity split surpluses is shown here in this final matrix of calculations, where we bring down for each year the amount of cash programmed for the recovery of corpus, plus the amount of surplus left over after fiduciary obligations are satisfied, to show the amount of fiduciary funds available in each year for new investment. We want to emphasize as we close here that other than some reinvestment to keep pace with inflation, which we have not modeled, none of these funds has to be reinvested in order to support corpus plus benefits. The original equity splits will continue to pour cash into this portfolio, supporting fiduciary obligations to the limit of the base case and beyond. Now consider the power that this gives the capital steward. If corpus is protected and benefits already funded, new investments can be pursued based on the impacts they will have. Some new investments will be selected for their positive financial impacts on fiduciary funds. That is good stewardship. Others can be selected as much, if not more, for their positive impacts on society. That also is good stewardship. In this way, you can see why it is that we say that evergreen equity splits are good stewardship.